And welcome back to the show. I'm your host, Lance Roberts. Danielle DiMartino Booth, former Fed insider, author of the book Fed Up, and of course, president of Money Strong. DiMartinoBooth.com is where you find all of her information, articles, etc. Danielle, welcome to the show. How are you?
I'm doing great. How are you doing today?
I'm fine. Are you back in Dallas?
I am back in Dallas. I flew home from Austin this morning, and I'm flying to Houston tomorrow. I'll be in your town.
Well, you should have let me know you're coming to town. We could have had you in studio tomorrow.
Well, I'll be flying out before you could have.
Oh, well, there you go.
About that.
Well, that's all good. Well, welcome to Houston when you get here tomorrow. Let's talk a little bit about Jerome Powell and the latest Fed meeting, and just from your take, just right off the bat, what was your take of the meeting and his first real kind of debut as Fed chairman?
I found it to be short, sweet, and to the point. Refreshing, very refreshing. And he said more, I think, than a lot of people realized he said.
And do you think that's...
Dun, dun, dun.
And you leave me hanging. But do you think that's maybe part and parcel of what's happening with the markets right now? Do you think the market's trying to read into what he actually said?
I do think that the market has begun to understand that there was nothing to parse or translate, and that in and of itself could be troublesome. Because that means that he actually might have meant what he said. Like, I'm thinking about 8 press conferences a year. They're like, oh, okay, wait a minute. That means that there could be 8 rate hikes a year, or that there would be flexibility in Fed policy, or that communications would truly be transparent. And so people are trying to figure out what to do with the common sense that he spoke of. I mean, he basically called the dot plots garbage in a very nice way as well, right. Just by saying, look, it's 3 years from now, people. How can we possibly ponder? Where's the conjecture? Why should we be talking about what's going to happen in 3 years? Focus on what we did at this meeting and move on. And
right.
He took all of 43 minutes to say it.
Well, and so there's a couple of things that are coming out of this. First of all, today, bonds had a huge day today. Interest rates dropped below 2.8%. Big reversal in the idea that rate hikes are affecting interest rates at this point. Of course, economic growth is showing significant signs of slowing down. Deflationary pressure is starting to pick up here, which, all kinds of undermine this idea of continued rate hikes. Do you think that that Powell will continue on hiking rates despite the fact that we're seeing weaker economic growth, not only domestically but globally?
Something else he said in the press conference was that the yield curve is something that he does indeed follow, pay attention to, etc. I'm sure you're familiar with Fred Hickey's work.
Yes.
I think it's Fred Hickey. Hickey wrote last week, somebody tweeted it to me, that right now we're experiencing the longest time in history of not having the yield curve invert.
Right.
And to me, that says that if we can finally get the yield curve to invert in a world of artificially low interest rates, you mentioned the 10-year coming down as much as it did. If we can finally get long rates below short rates, we're going to be in the soup.
Right. And by the way, speaking of that, when you talk about the 10-year coming down and potentially going below the 2-year, we're very, very close on that front after today in particular, because short rates have been coming up, particularly with LIBOR spiking up, and, of course, the Fed continuing to hike rates on the short end. That's been lifting the short end of the curve. The long end of the curve has been flat and now actually declining. There's a real risk here. And, again, when we start taking a look, and so let me spin gears here just a little bit because this all ties together. We've got a government now that has gone on an unadulterated run of spending by passing a 2-year continuing resolution that completely eliminates any type of debt ceiling. We just passed a $1.3 trillion spending budget just for now till September, just 6 months. And we've already ran up our national debt by $1 trillion in the last 6 months. This suggests 2 problems here. One is that increases in government debt are deflationary to the economy. interest rates are coming down, and we've got this potential of an inverted yield curve, which none of this really plays well for a Fed that is intent on hiking rates. All that to ask you this one question. Do you think the Fed's hiking rates, understanding that we are closer to the next recession than not, and they don't want to be caught at 1.5% when the recession hits?
You know, it's a great question, and I would probably, if I had to guess, I would put Powell in the camp of people who actually occupy planet Earth, who understand that zero interest rates are a bad thing for a country that has something called a banking system. Mm-hmm. So I don't, I think that the question is he trying to get to some kind of a new low that he won't then breach? Mm-hmm. It's hard. That would be my fantasy. By the way, I just said it. Right. 2% is the new floor. That would be my dream come true. But we're not there yet. Right. We're still not there. And much more to the point, General Mills, yes, the cereal maker. General Mills came out and said in their earnings report that their input costs, the cost to buy the boxes, was smoking their profit margins. Mm-hmm. We are going to hear echoes of that in the coming weeks when earnings reports start to trail out one after another. That inflation is a very real thing. Right. And so there is a conundrum right now, because if inflation is real and growth is slowing, you have a different kind of you have a whole different sort of trouble on your hands. Right. It's the biggest fear of economists, and I think the financial markets, is the repeat of the 1970s stagflation. Exactly. And that is a gigantic boogeyman. And so in your opinion, and as we get ready to wrap up the segment, so Danielle, if you've got the crystal ball here for the next few months, we just put Larry Kudlow as the National Economic Council advisor. We've got the Trump administration doing what they're doing. What's your outlook on the next? And of course, the market's certainly in a bit of turmoil right now. What's your outlook here? This is not a good. This is not a healthy environment that we're seeing right now for risky assets. People, I was at an investment conference yesterday with a bunch of brokers, and they were elated that somebody had come in and bought the dip, mm-hmm. and that the market was up big. And I made the comment: volatility comes in both ways, good and bad. And right now, whether the market's going up or down, because it's behaving so erratically, this is really not a good sign. Yep. Somebody made the observation a few days ago that if 2018 was to end today, it would be one of the most volatile on record. Right. Hello? Yeah. Well, and again, we've talked about this before, is that the only times in history where you see markets moving 300, 400, 500 points in a day have always been either at peaks of markets or during the middle of a bear market. You don't see these type of actions during a normal trending market, right? People should step back from this and saying, this volatility, what's happening here, this convolution of trade wars and all this other stuff, the markets are telling us something, and we need to pay attention to that. Danielle DiMartino Booth, get by our website, dmartinobooth.com. Get signed up for our newsletter, and most importantly, read her book, Fed Up. It's a great read. You'll enjoy it. Danielle, we thank you so much for your time, as always. And next time you're in town, let me know, and we'll have you here in the studio. Absolutely. I'll make a point of it. Thanks, Danielle. See you soon. Thank you. All right, bye.